Brandywine Global is an asset manager with approximately $67 billion under management. Approximately $45 billion of that is in fixed income. My role at the firm is as a portfolio manager on our multi-sector and multi-asset credit products. Yeah, this has been a trend that's been in place for a while. Some of this came about under the guise of national security or energy transition to start out. And now under the new Trump administration, there's talk of trade tariffs. And I think those are real threats to fixed income. They can result in inflation if implemented in broad terms, particularly if there are retaliatory tariffs. But I think overall, the general goal is to get a larger share of trade for the U.S. and ultimately strike a deal that's cooperative, certainly that will benefit the U.S. more. But I think the direction of travel there is that it can result in higher inflation for a period of time, and it's another source of potential volatility in fixed income markets. Yeah, there is a playbook from the prior administration. I think what can be a complicating factor, though, is a starting point of initial conditions. Fiscal authorities are now pushed up toward budget constraints. Investors are pushing back on the fiscal largesse from the governments globally, particularly in the developed world. And so I think the playbook is there from the prior administration, but it's not necessarily going to be the same. It can rhyme a bit. In addition, I think the speed with which the new administration put its cabinet in place, there's still uncertainty around how that ultimately looks, but it's there. There's been some pre-planning, some discussion on how to exactly shape this policy. So, the Federal Reserve just cut rates by 100 basis points. The U.S. is at full employment. There are continued fiscal deficits in the economy. Monetary conditions, in terms of financial conditions, capital markets access, it's wide open. So I think all that provides tailwinds to the U.S. economy continuing to do well over time. The service sector has been strong. Manufacturing has been the weaker part of the economy, but even that is starting to inflect higher over time. And so I think the U.S. is sitting in a pretty good place right now, and that growth should continue into 2025. Yeah, it will ultimately depend on how those are implemented. I think more of a domestic focus can be a double-edged sword if it reduces global trade volumes, if cross-border trade flow is reduced right away. I think that can impact corporate profitability and potentially the labor market in the U.S. But the end goal, I think, is for the U.S. to have a bigger footprint in global trade. And it's going to depend completely on the complexion of policy tools and how they're implemented over time. If this is a way to get a deal that's better for the U.S., more beneficial to have more domestic production of goods, then I think longer term that can be a tailwind for the U.S. economy. But it will fully depend on how this is ultimately implemented. The market trend is that we have tight spreads but high yields. And I think that's for good reason. Fiscal authorities across the globe don't have shareholders to answer to. Fiscal spending has been supported on a bipartisan basis, and tax cuts from the Republican side of things, more spending from the Democrat side of things, probably more spending from both parties. And bond investors are starting to push back on that, and it's manifesting itself through higher yields in government bonds. On the corporate side of things, management teams, as I mentioned, have shareholders to answer to. They have a cost of capital and profitability concerns. And so those management teams have been good stewards of balance sheet post-COVID. You saw the repayment of gross debt post-COVID when rates were very low. And that was different. They were proactive in balance sheet management. And I think with higher yields, that's a theme that's going to be in place for a longer period of time. And so the discipline's enforced in corporate credit. It hasn't been enforced until more recently in sovereign bonds, and I think that's set to play out. I think there's good reason for spreads to be tight right now. And just because spreads are tight, I don't think that's a reflection of a lack of opportunity in corporate credit. There are high single-digit total return investment opportunities at the front end of credit curves that you don't really have to extend spread duration or go down in credit quality to find an investment opportunity. What I was speaking about there was actually high yield issuers at the front end offering those mid to high single digit total return opportunities. Within investment grade, spreads are tight. That's going to be a sector with spreads this tight that's going to be more sensitive to interest rate moves. So if treasuries sell off, spreads can still tighten there, but there's less of a spread cushion or a running yield to prevent those bonds from really going down in price. So it would eat into your total return proposition, whereas more front-end high yield, the running yield there provides cushion of up to 250 basis points of spread widening. So in the event of an unanticipated adverse outcome and spreads widen, you have that cushion in the high yield universe that's not necessarily there in IG out the curve. I think in terms of industries, some of the hype around renewables, the wind may come out of the sails there a little bit. I think the industries that would potentially benefit are those that would see deregulation as well as increased M&A. Within high yield, you could see further M&A in the energy sector, the oil and gas sector, so further consolidation there. So despite tight spreads, you could get further spread tightening if an IG acquirer buys a high yield company. The banking sector and financials, I think, could benefit from deregulation. So I think it's more looking out for the sectors that would benefit from the new administration rather than thinking about sectors that are going to be really negatively impacted by a new administration. Brandywine's credit approach really focuses on yield to outcome. And so generally speaking, I think that statement's accurate. If you're considering the beta side of things, it's more of a running yield or a carry story. With financial conditions very loose and management teams having to focus on balance sheet, I think that there's the callability or the potential for M&A can lead to more upside rather than just the carry in a lot of different capital structures, but it's going to require managers to really hunt for those and be dynamic in their approach as valuations change. It was another strong alpha year, consistently implementing a process that seeks to exploit the inefficiencies of credit markets and that beta hunting that I think a lot of the ETF flow generates, and turning that on its head and looking at the underfollowed sectors of the high yield market or those smaller cap structures and taking meaningful positions in the lower weighted areas of the index, I think from a structural standpoint, from a market inefficiency standpoint, really allows that alpha generation. In addition, really active trading has added value through time. So as credits perform, spreads tighten. I think all of that investor base, all those agents are going to have to find managers that are going to be dynamic, that are going to be active. Because as we had mentioned in the prior questions, spreads are tight and yields are high. You need to really identify those credits with a compelling valuation proposition and be willing to sell out of them as spreads tighten. Your room for error in a tight spread environment, if you're just buying beta, is not as high. And so I think it's really going to take an active, dynamic approach in order to be successful in that endeavor. In the more sovereign mandates in the past, yes, Korean govies have been part of the investment, part of the portfolios. Currently, I think there's some opportunistic trading going on with the currency, but really from the government bond side of things, I think it's not a knock necessarily on Korea specifically, but more the global landscape. And Korean bonds, in particular, yields have come down quite a bit. The valuation proposition is not necessarily there. Korea also faces domestic political uncertainty, in addition to external political uncertainty vis-a-vis trading and tariffs. So I think it's going to take a cautious approach there. But Korea is going to be included in the WIGB in November of this year. As a country, strong tech and manufacturing presence, I think it's reason to be positive on the Korean economy, but again, from a valuation perspective, we're not involved at this juncture.